Hey, everybody, welcome back. We're going to talk about part three, which is the income approach, the other way to measure uh, GDP. So, we're going to talk about the income approach to measuring GDP. That's the goal. The income approach is the idea that if all the spending in the economy should be equal to all the income in the economy. They should be the same thing. And what we're going to do is we're basically going to measure GDP by adding total national income. And our national income is wages, rent, interest, and profit. And then there are going to be a couple changes we're going to have to make, which are depreciation and statistical discrepancy. And then we'll get to net foreign factor income as well. So this one is not going to be as clean as the expenditure approach, and that's why we focus on the expenditure approach. Um, these, at the end of the day, will be equal to one another. So we start with national income. Expenditures on final goods and services flow as income to private citizens or to the government. And that is going to be our wages, rent, interest, profit, plus government revenue from taxes. So here you can see we're going to start with this top part of our equation. Um, so national income is compensation to employees, which is wages and salaries. But on top of that, that also includes benefits. Um, so what your employer is putting towards your healthcare or your social insurance or your pension. So like as teachers, we have pensions, and the money that the employer puts in there is counted as part of my wages and salaries. Rent, that's payments received by households and firms which supply property resources. So easiest way to think about this is when a store pays rent for a space in the mall, or um, people rent out offices. Now, what we use is what's called net rent. So that takes depreciation of these spaces into account. Interest, that is money paid by private businesses to suppliers of loans used to buy capital. So most businesses, when they purchase capital, use loans to do so, and that is the interest payments they're making on that. This is also the interest that households receive off of accounts that they have in the banks. Um, and payments made by the government, what the government's paying you, that is excluded. That is not counted as part of our income because really that's just a transfer of money um, from ourselves to ourselves because the government's getting it from taxes. Proprietor's income, uh, this is kind of the profit side. This is the profit of proprietorships and partnerships in non-incorporated businesses, and then there's corporate profits, the profits of corporations. So wages, rent, interest, profit. Corporate profits, we've got their income taxes. That part of their profits are going to flow to the government. The dividends, those are going to be what flows to the stockholders or households. And undistributed corporate profits are the profits that stay within the company, typically used to help that company grow by investing in new capital goods. And then there's the taxes on production and imports. These are what we call indirect business taxes. These are things, the sales tax, excise tax, business property tax, all the things that we are paying to the government. Um, and by we, I mean businesses. Sorry. And those are flows of income. It's just income that's going to the government. So here you can see the example of a 5-cent sales tax. Uh, when a customer buys it, they pay $1.05. So we have to account for that entire $1.05. So just counting the dollar that goes to the business doesn't cut it. We have to take into account taxes. So at the end of the day, we add up employee compensation, rents, interest, uh, profits, and those indirect business taxes. And we are not going to get anywhere near what the expenditure approach of GDP tells us GDP is. You can see in 2009, we were off by $2 billion, give or take. That's a lot to be just kind of missing. So we have to make some adjustments. And those adjustments are going to be uh, looking at three different items: net foreign factor income, consumption of fixed capital, and statistical discrepancy, which is by far my favorite economic concept. So the first thing is net foreign factor income. Uh, our national income includes the total income of Americans, whether those Americans are living in the United States or living abroad. But since we're trying to just measure domestic output, we have to do some adjustments. We have to add in the income of foreigners living in the United States, and we have to subtract out the income of Americans living overseas. Typically, uh, we tend to see that Americans uh, abroad earn more than foreigners living in the United States. So net foreign factor income tends to be a negative number, and we actually get further away from our income approach and expenditure approach being equal. Um, then we've got the consumption of fixed capital, depreciation. So this is where it gets a little bit complicated. Businesses are allowed to depreciate the value of their capital equipment. So say you have an oven that costs $10,000 and is expected to have a useful life of 10 years. Each year, the baker can depreciate $1,000 worth of value off of that oven, and that way they don't just have the price of that oven in one given year. They can spread it out over the cost of the lifetime, and it shows us what is being used up each year. Um, this is a complicated thing, and how businesses do it um, is complicated. We also have to depreciate publicly owned capital for public goods, and um, it basically shows what of that good or service has been consumed in any given year, trying to help us equal out GDP. Um, and it shows us what part of GDP in this year is being set aside to help pay for those things again in the future. So that gets added to the national income to achieve the balance. Then at the end of the day, when we do all this, when we add up wages, rent, interest, profit, we add whatever's going on with net foreign factor income, when we look at depreciation, these two things are not going to be equal. So economists throw their hands up in the air and they say, well, whatever we're off by, it's just statistical discrepancy, and we add it in. This, I don't think you could do this in any other aspect of life. So I think you should try it the next time you have a math test and you get the wrong answer. Just say statistical discrepancy. But here's the deal. At the end of the day, this is why economists don't use the income approach. You can't even get the income approach without the expenditure approach. And when you look at the bottom there, in 2009, statistical discrepancy was $209 billion. So we're not talking about, 35 cents. This is a big deal, and this is why we don't use the income approach. So it's your wages, rent, interest, profit plus stuff. That's the scientific equation for those of you keeping track. So here you can kind of see the ease and the complexity and why we stick to the expenditure approach. Consumption, gross investment, government spending, net exports equals wages, rent, interest, profit plus stuff. We're going to stick to the left-hand side of this. moving forward. Shockingly, the Bureau of Economic Analysis thinks the expenditure approach is much more reliable. Shocker, I know. So just a couple ways to look at it. So we've got a couple other national income accounts that we're going to talk about real quick, and then we'll be done with this one. So personal income is a big measure that we need to know about in the economy, and it's what is the income received by households, whether earned or unearned. And that's kind of a weird concept. We think all of our income should be earned, but for some households, it's not. Earned income is our wages. What we're getting from employment and things like that. Unearned income is things like welfare, disability, education. Social Security is technically considered not earned, even though most of us have been contributing our entire life. So, to get personal income from national income, we subtract out income that's earned but not received, so money that flows out to taxes and things like that, and add income that's received but not earned. So, at the end of the day, this gives us how much of our country's money is sitting in households. I like to think of it as what actually gets to the households. Disposable income is probably the most important measure in the economy as far as consumption is concerned. This is just personal income minus personal taxes. When we take taxes out of personal income, this basically gives us how much money in the economy could be spent today. How much money do people have? And all of our disposable income goes one of two places: consumption or savings. So you also see disposable income as laid out as consumption plus savings, which is what we'll use a lot in this course. So the idea here is we can only do two things with our money. By definition, if we don't spend it, we're saving it. Whether we're saving it, underneath the mattress or in a bank or in an investment, doesn't matter. If you don't spend your money, you are saving it. And if you are saving it, you cannot spend it. So there's the equation there. We tend to lean more towards this one in the rest of this course. Just keep in mind. There's kind of your summary of how we get all these things and the mess that it is. Like I said, we're going to focus on the expenditures approach to GDP. One last thing, we didn't actually use GDP as a measure until 1991. Prior to that, we used gross national product, which was the total dollar value of all final goods and services made by Americans. So we looked at what is the income of Americans, no matter where they were in the world. And the switch to GDP in 1991 was to really give us an idea and to acknowledge that when Americans are living abroad in Nepal, the money they make doesn't really matter to the U.S. economy. They're not paying the taxes here. They're not spending it here. So why do we care? And that's why we move towards GDP. All right. Have a good day.